Starting now. All right.
We're live.
I think now we're live.
Okay, hello everyone. We're going to let people filter in for about another minute. I know I'm joined here by my co-presenters. Hey Ben, how you doing?
Good, Ray. How are you?
Well, I tell you, I'm fighting, weather here on the East Coast getting up to 100 degrees, but isn't that like a standard day for you in Phoenix?
Yep. Yeah, be about 100. Not too bad here.
Yeah, with no humidity though, right?
Yeah,
It's
no
dry.
humidity. 15%. Yeah, sorry.
Albert, where are you dialing in from today?
New York City.
Okay, so you're getting ready for the heat wave.
Yeah, it's not that bad yet, but it is going to get bad on Thursday, Friday, indeed.
Okay. Well, we're just going to take about another 30 seconds and let everyone finish filtering in. One of the things that would be great during today's presentation, I know Ben and I have done these quite a few times. It's my first time doing a webinar with Albert, but we'd love for people to ask questions. So feel free to ask questions in a Q&A. We'll have it moderated. But the real benefit of these sessions about benchmarks and metrics is really about answering the questions that you may have. So let me go ahead and get started. So welcome to the 2026 Financial Benchmarks Report webinar. We're focusing on some of the really interesting things we've found this year, which was efficiency has arrived, but we believe it came at the expense of growth. And today I am joined by Ben Murray, the SaaS CFO, and Albert, the co-founder and CEO of Aleph. I'm going to let you introduce yourself real quick. Start with Ben, then Albert.
Yeah, greetings, everyone. Great to be here. My name is Ben Murray, and my background, I was an in-house SaaS CFO for founder and private equity-backed businesses. Started my blog in 2016, talking SaaS finance and now AI metrics today. Do some fractional stuff, have an academy, podcast newsletters, all centered around SaaS and AI metrics now. So great to be here.
Yeah, and I'm Albert, co-founder CEO of Aleph, which is AI-native FP&A tool. Before starting Aleph, I was a management consultant, worked a lot with CFOs. Then I was a CFO myself. I built my own tools to make my life better. And then I decided to start Aleph to hopefully help other finance teams. And Aleph is now Series B. We raised $50 million, have over 500 clients, including some great, AI-native tool companies like Zapier, Harvey, Notion. And yeah, excited to share stage with you both, Ben and Ray.
Thank you, Albert. Ben. And I'm Ray Rike. I'm the founder and chief evangelism officer for Benchmarkit. We're the B2B recurring software industry's largest benchmarking database. Over the last 6 years, we've conducted over 100 benchmark research projects. Over 25,000 companies have evolved, now 2 million data points. And our seminal annual research is our financial performance metrics for recurring revenue companies. And Aleph was the sponsoring partner of that this year, and that's what we're going to talk about. So without further ado, let's move on. So we're going to talk a little bit about that report. We're going to talk about what we found with revenue growth efficiency. We're going to talk about the evolving nature of the customer lifetime value to CAC ratio and why expansion revenue is really critical to that. We're going to talk a little bit about the trends we're seeing in gross and net revenue retention and what's driving the best performance for those two core metrics. Rule of 40, even your smaller companies out there, 10 million, 15, 20 million, don't overlook this critical metric. It is now the number one metrics that's impacting enterprise value to revenue multiples in the public SaaS space. And then we're going to have Ben double click a little bit on how AI is impacting some traditional metrics that we in the recurring revenue industry have focused on for a long time. Everyone's going to be able to get a free copy of this report and also access to the interactive benchmarks. You can see the link down here, take a picture of it. Afterwards, you get a link to it so you can click. But what's important here is benchmarks should never be viewed primarily in context of total population. Benchmarks need to be relevant to your company profile. So your company ARR size or your annual contract value size, even pricing model. So at this site, you'll be able to see all of those specific to your company profile. So with that, Ben and Albert, I'm going to just kind of highlight the first thing we found, and that is CAC payback period, a primary customer acquisition efficiency metric, actually decreased by 11%. That's a positive, so I put plus 11, but it actually decreased by 2 months. So we'll talk more about that. The rule of 40 on the bottom left actually increased by 10 points year over year. And this is the similar cohort as the previous 4 years. But the annual growth rate, now these are all medians, and we'll show you that in a minute. It actually decreased by 6%. And at the same time, we also saw that gross revenue retention decreased by 4%. So Ben, I know you've seen these benchmarks, but I wanted to throw it over to you and say, did any of this surprise you seeing it in a research report versus what you were seeing day to day?
Yeah, 3 of the 4 boxes, not really surprised. But yeah, the CAC payback period, and we'll see some of these other slides. Yeah, that was a little surprised that we know the environment has gotten harder and growth has slowed. And usually efficiency gets worse in that environment. But CAC payback getting better was, yeah, that for me, that was a surprise.
And Albert, I ask you the same question as a CEO of a recurring revenue software company and having over 500 current customers. Did anything jump out at you about this at a high level?
Yeah, no, I think it like makes sense to me, and I think I'm probably like not surprised by it. Building on what you're saying, Ben, I think I definitely see, in conversations with, our board, but most importantly with customers that, I chat with a lot of finance teams. I think there's definitely growth at all costs is over. The 2021, 2022 is far gone, much more focused on efficiency. So I think the idea of we're trading off, part of the slowing growth might be the environment, but part might be companies actually prioritizing efficiency over growth and making a deliberate trade-off. So I think, like that narrative, I think fits the data we're seeing well.
Okay. Well, I'm going to go into the 4-year trend. So this is from a population of a low of like 338 to a high of 1,800 in year 2023. And you'll see at median these charts that our median growth rate for this private company cohort, started at 30%. We know what happened in the second half of 2022. I was a little surprised that it went down so much between calendar year 24 and 25. It was down from 26% to 20%. And everyone was impacted by this reduced growth rate. Even the top quartile, which was 50% in the previous year, 42% in the latest year. So Ben, I'm going to kind of go back to you on this. I thought growth was going to stabilize a little bit more in 2025, but it actually decreased more than any other year. What say you?
Yeah, I mean, at a macro level, I'm not surprised, because I think in some of the interviews, talking to SaaS CFOs and advisors and in my client base, where we thought even the year before, oh, things are going to pick up. And then nope, it was just very steady. And then, all right, next year things are going to pick up. So I think growth is in the eye of the beholder, depending on who you talk to. But for me, this resonates. But I see a lot of different verticals within software. And I think it also depends on the vertical. Some, right, are growing super fast. Others are just like, all right, we just have to maintain runway. It's really slow. We have global, events going on that impact the buying process. So I think there are a lot of stories behind this, but overall, yeah, this fits with what I see.
Yeah, now to a lot of the people out there, it's like, hey, Ray, you're telling the man holding an umbrella that it's raining outside. But Albert, so the question to you is, as both as a CEO and with 500 customers who build their planning with your solution, what's the first things, if you see this type of growth decline, what's the first 1 or 2 things that you as a CEO or you would advise people to really consider looking at?
Yeah, I think the first one, which I feel like I might say multiple times throughout the conversation, is not looking at one metric in isolation. You need to look at a series of metrics, and growth and efficiency are 2 things that are clearly side by side. So sometimes like growth going down in exchange for something else getting better might be a valid trade-off that you might actually be okay with. I think the other part starts to be, okay, how can we go upstream? Growth in the end is like the ultimate downstream metric and the ultimate lagging metric. So how can you start looking at like the things that are upfront, right? Like if you're seeing slow growth, there's probably, if you're B2B, there's things around like conversions through the funnel. There is, quote attainment. That's probably what I would start to look at and like go into more of that sales capacity and understand where in that funnel things are breaking down and like start going from there.
Great advice. Okay, on to the next one. I mentioned you never want to look at benchmarks against the total population. So this is just one where we did it by company size because the highest correlation on company growth rate is company size. And you can see how as companies, got a little bit bigger, that the growth rates actually decrease. The one thing that's jumped out at us, and this is 2 years in a row, is that smaller companies, typically, you'd see 50, 60, 100%, 200% growth rate. We've seen this twice now. We have a larger population that smaller companies, not AI native, but in the more legacy B2B SaaS recurring revenue business, are growing slower. So I'm not going to throw anything over to Ben and Albert on this one, but it's just something to note. Now, the next slide is what's really interesting. And we started doing this 3 years ago. And this shows the eternal optimism of founders and the entrepreneurial spirit. So for the third year in a row, the planned growth rate at median, at 75th percentile, and at 25th percentile was higher than the previous year actual growth rate. So the planned growth rate for the entire population was 26% for 2026 versus an actual growth rate in 2025 of 20%. So a couple things. And Lucas, I'm going to ask you to throw up that poll about how first half 26 is doing as far as growth rate. But Albert, I'm going to go to you first as a founder and entrepreneur. What do you think about this eternal optimism in companies building plans that have a higher growth rate for the current year than you saw in the previous year?
Yeah, it's interesting that like it seems to we have more pessimists here in the chat than in your survey. Okay, now it's starting to switch real time. It's interesting. I mean, I like it a lot. I know for as much as I'm a finance person, FP&A specifically, I'm very much, I try to be very pragmatic when it comes to plans. I think like plans are, there's different things, if you're talking about like cash management and you're talking about, a 13-week cash flow, precision matters quite a bit, right? Like there's boundaries in which missing your plan by a lot actually has a very negative impact on the business if you're not taking the right precautions. Having said that, I do think that also plans, part of that is motivating people and aiming, helping the team aim for something aggressive. So I do like, I do like realistic but ambitious plans, and I think they can be a great forcing function. So I'm actually, I like the founder optimism, and I feel like I'm an optimist and myself as well.
Ben, I have to ask you as CFO here in the audience, when you have a client that shows you this type of optimism, how do you manage the budgeting of the expense side of the business?
Yeah, I mean, it has to be supported, right? And as a practitioner, I think if we're a high flyer and we're growing 200%, yeah, it can be very hard to hit those growth forecasts. But if we're a more mature company growing 15, 20, 25%, my expectations, we should be pretty close to revenue plan, unless we have a very short sales cycle where we have a lot of at-risk revenue being forecasted. That's the fun part of planning and forecasting. And, all these things move together. So yeah, one, if a founder comes to me with a kind of a hockey stick forecast, it's got to be supported. Why do we think it's going to change? And of course, expenses, resources have to match that plan to support that revenue goal. But I'm a big believer we don't know where we're going unless we know where we've been. Those unit economics, the fundamentals that we build forecasts and budgets off of. So I'm definitely not surprised as CFO. I a little bit cynical when I see those, and you have to dive in a little bit deeper.
Gotcha.
Sure.
And as we go along here, I'm going to ask Lucas or you, Ben, if there's any questions. Let's make sure we address them during the slide. Okay.
Yep. Any questions? Please post those, guys.
Yeah, we'll do a more formal Q&A towards the end, but we're also keeping an eye on the chat, so feel free to ask ahead.
Okay. Now we talked about CAC efficiency, and there's a couple, and we're going to go over 3 metrics here that cover CAC efficiency. And the most standard one that a majority of recurring revenue companies are using is CAC payback period. And though I'm not showing the overall average here, which did decrease from 18 months to 16 months for the entire population, what was interesting, Ben and Albert, was the highest growth organizations, those growing more than 50%, had the most efficient CAC payback period. 31 to 60% had the second most efficient. So I looked at this across multiple efficiency metrics, including the CAC ratio, CAC payback period. And I was both a little surprised, but really inspired to see that increased customer acquisition cost efficiency actually doesn't come always at the expense of growth. It actually can drive growth. And what I saw was companies growing the fastest were spending the highest percentage of revenue on sales and marketing, but also had the most efficient CAC efficiency. What do you think of that, Ben?
Yeah, it's surprising. And I review these metrics every month with the SaaS founders and clients that I help, and always look. One thing, is really important when I look at go-to-market efficiency metrics. First, how much are you spending in sales and marketing as a percent of revenue? If it is less than 10 founder-led sales, well, those metrics aren't going to be very valid yet. But if you're spending 15, 20, 30, 40% in sales and marketing, yep, we're going to look at these metrics, because now there's enough data flowing through the business where the calculations are valid. So this is a bit surprising. Now, is this temporary, Ray, where we just pulled back on sales and marketing? Efficiency shoots up, but we're feeling that pain in sales and marketing. We'll see how this plays out next year. But it is, that's not what I would expect.
Yeah, well, over the last 24 months at median, we've seen almost a 10% reduction in sales and marketing as a percent of revenue. So, Ben, I do think we're shrinking to try to grow faster. That's one of the major trends I've seen.
Yep.
Okay. Albert, let me ask you this question. Do you and your clients, do you use these type of CAC efficiency metrics to factor into the planning process? And how often would you say, hey, we need to relook at our CAC efficiency numbers and reevaluate our budget and business plan?
Yeah, I think CAC payback is probably one of the most popular ones, I would say. And I think it's one of those, also it's one of the ones that is hardest to calculate properly. I have been in many, I think the difference between, just throwing some numbers and having a first pass at it versus really analyzing what should be part of this or not, that's something that we spend a lot of time discussing with customers on. And I think there's, it's very easy. I mean, I'm expecting here a lot of your survey respondents, right, to be on the discipline side and take these, very properly and have the proper answers. But this is one of the ones that's easier to misrepresent, I would say, inadvertently, not wanting to. Yeah.
And one of the things I do want to highlight, and this is the importance of standards, and Ben and I were co-founders of the SaaS Metrics Standards Board. So on CAC payback period, the ones that you see here are using a gross margin adjusted basis. And this is looking at new ARR for the year, not net new ARR, but actual new ARR divided by, on a gross margin adjusted basis, divided by the actual sales and marketing investments. So I just wanted to make sure people knew that this did not include churn or things like that. It was new plus expansion.
Yeah. And to me, the part that I do think that having discipline on calculating the right way is important, but also on, I think especially, I know, Ben, you write a lot about this, and I've seen you talk about that, but like what you include in sales and marketing, doing like proper allocations of things that, it's very easy to fool yourself by hiding a lot of sales and marketing spend in OpEx. And then, we have a 3-month CAC payback, but it's like, like the salespeople are actually, not there. And, it's very easy to, you shouldn't have like good accounting discipline to, make the wrong strategic choices because of that.
Yeah, it's easy to go haywire on this. It's the formula's simple, but the inputs you really have to watch the coding, the new versus existing allocation, segmenting your CAC payback. So just a couple levers could show an 8-month, and then you flip a few things, and then all of a sudden it shows 12 months. So you really have to put some thought into it.
Now,
And
go ahead, Albert. I'm sorry.
Sorry, CAC payback is one that I'm particularly passionate about, and I think it's great. So I wanna build on something that Ben said, which is the segmentation. I think CAC payback as an average is useful, and it's an indication of where your business is as a whole. Internally, we look a lot around our marginal CAC payback because it's basically when you have a blended CAC payback like this, it includes things like ARR that you want because of referrals, which is typically very low CAC and it's very easy. But if you're actually like the more interesting thought is if I'm putting more money into the business, what's the payback that I will expect from that? And it's typically less performing channels that are the ones that are able to receive money. So I think the idea of marginal, which again, it's hard to benchmark against, but I think as using it as a metric internally, marginal CAC payback, much more interesting as well.
Yeah, in fact, that's a really good point, and I harp on this all the time, right? If you go to the interactive benchmarks on the website, you'll be able to see this by ACV, your average annual contract value, and that has the highest correlation to CAC payback period. A 5K product is much different than a 100K product. But now, Albert, this is my favorite customer acquisition cost efficiency metric. It's called the blended CAC ratio, and you basically take your fully loaded sales and marketing costs, and you divide it by the amount of new ARR, both new logo ARR plus existing customer expansion ARR. And just like CAC payback period, so it's good to see when you have survey-based research actually have consistent outcomes, but it was $1.30. So it says we're spending $1.30 at median to get $1 of new ARR. I know, Ben, this is a metric, and you also, I believe, call it cost of ARR, but you have every one of your customers really managed. Is that correct?
Oh, yeah, definitely. This is a metric I calculate through my entire customer base, whether you're B2C, B2B, AI, high price point, low price point, to look at those trends. And again, a little surprising here, but I don't know if we'll have another slide. Ray, I was digging into your data last night. I've got a post coming out tomorrow on some of your data. And right, blended CAC ratio, cost of ARR, is both new and net expansion. So what's the weighting? And and I'll leave it there, but the weighting can definitely impact this efficiency metric.
Oh, Ben, I got to respond because I don't think we have a slide today.
Oh,
we started doing this 5 years ago. The median was of 100% being total new ARR, 30% came from existing expansion. This year it's at 42%, but more importantly, for companies over 50 million, it was greater than 50% of new ARR came from existing customer expansion. So there's been a heavy shift to the expansion motion.
Yep, and that weighting, because we know the data proves out cost of expansion ARR is cheaper than new logo acquisition.
And Ben, we're going to actually show that in just a minute. I'm actually going to go to new CAC ratio, then we're going to go to expansion. So new CAC ratio just looks at your new logo ARR. It excludes your expansion from existing customers. And you see where that was actually at $1.30 last year. So that's actually pretty efficient. But what I'm going to do in interest of time and what you just said, Ben, I don't have it. But expansion CAC ratio was at 80 cents. So that says that we're spending 80 cents of sales, marketing, and allocated customer success costs to the expansion motion for every dollar. So if you've got $1.30 of new and 80 cents of expansion, you can see how the unit economics favor that of expansion. I don't know if you have more to say about that. I'm going to toss it over to Albert then.
Yeah, no, interesting, because the cost of expansion ARR has always been like in that 70 to 80 cent range ish for medium, but then it popped up, and it's interesting that it's gone back down now. So, because that has been kind of that rule of thumb for me of expansion ARR, say, it depends on your ACV too, but 70 to 80 cents.
Yeah, in fact, what happened in 2024, Ben? Everyone was throwing a lot of customer success resources and programs at both retention and expansion. It went up from 4 years ago, it was at 69 cents. Last year, it was all the way up to $1 for expansion CAC. So it came down 25% to 80 cents this year. So it was a really good motion.
Yeah.
Hey, Albert, let me ask you this question. And I don't know enough about your go-to-market motion, but what do you think about a best practice of measuring the cost to acquire $1 of ARR from a new customer versus $1 of growth ARR from an existing customer?
Yeah, I mean, I like these webinars because I always learn something new. To be honest, we don't look at this that much from that lens. I think when it comes to our expansions, we look much more at things like, ARR per CSM and more of from a book of business perspective and less from an expansion perspective. I think it's slightly different. Our products also, our CSMs are not only don't have a commercial mandate as much as just make customers successful and help them through the life cycle. And we have a bit maybe too naive of our approach of, let's just make them very successful at what they hired Aleph for, and revenue and expansion will come down the line. So we don't look at some of these efficiency metrics as much.
Yeah, I'm going to double click on this one more, Ben. And that is, we know that usage-based pricing, or maybe I should call it variable-based pricing, because outcome pricing is becoming more and more popular. It's a dominant model now. And two things I wanted to ask you about in calculating the new CAC ratio versus expansion. When does new ARR end, and when does expansion ARR begin? And does it really matter to try to understand that, define it, and measure it separately?
Yeah, that's a good one, because I talk about this in my course. If you have a PLG motion, you have to define, because that question comes up a lot. Well, what about implementation services? It's like, well, when does the sales cycle end? In traditional SLG motion, when we sign the contract, CAC ends at that point. But now if you have PLG outcome-based pricing or PLG usage, you have to define that. That affects comp plans, commission plans, and impacts these ratios. So I think you've got to have those internal discussions with your sales team, with RevOps, with finance, because that will hugely sway these numbers.
Okay, I'm going to go on to not a new metric, but one that I see becoming increasingly important. And that is customer lifetime value to CAC ratio. And Ben, you may even have posted on this. I'm sorry, I don't remember exactly. But now that we're doing more of that land to get the customer and then expand by getting them to use it more and more using both PLG and/or usage-based pricing, you may see a really poor initial new CAC ratio. But over 2 or 3 years, if you get enough expansion ARR, this customer lifetime value to CAC ratio, which the old conventional wisdom was 3x, now I'm seeing it 4. And as you see, the fast growers, they're getting 7 times more customer lifetime value ARR compared to CAC than everyone else. And how does this get impacted in the AI native business you're doing?
Yeah, and it's back to Albert's point. You have to look at metrics and context. So when I see low LTV to CAC, say you're at 3x, which was the old rule of thumb. And I'm glad you pointed that out, Ray, because your data shows really the rule of thumb is about 4 and above. All right, if we have a 3x LTV to CAC, all right, let's look at our expansion motion. Is that part of our sales strategy where we're getting them in low? It could be the current environment where we just have to have deals that are lower in size, but we'll get them, we have a nice expansion motion after. So yeah, you have to look at all these together. And then, yeah, if you have an AI product line that is LLM based but you're charging a subscription for, now you have to look at this new metric, compute adjusted LTV, because your heavy users could be burning your margin, your light users making money for you. So we're in new territory for CFOs and FP&A teams as far as the data that we need to find and work with our dev team on, when it comes to LTV to CAC.
Yep.
Yeah.
Ben, let me double click on that, because that compute adjusted, I always saw CLTV always being gross margin adjusted. You're just saying now, since gross margins are being pressured and compressed, it's even more important to do that compute cost adjusted model?
Yeah, because we know, and I think Albert mentioned, like the incremental cost of serving a customer is really low under the SaaS legacy model. But now if we are an LM, like tokens, inference powers that AI product line, now we have traditional COGS that are part of it. We have to support that. We may have customer success if they don't sell. We have traditional hosting, but now we have all the inference costs, the infrastructure costs, and that's drawing on our COGS. That's increasing the COGS there. So yeah, your LTV is, before it was like we just have one LTV to CAC, or maybe we segmented, but now you could have 3 LTV to CACs on one product line if it's an AI product line.
Yeah, good point.
Yeah.
Albert, is this a metric that you and your customers use a lot?
So I think like we have here Ted I think I share a bit of Ted's comment here in the chat that's saying, LTV is easy to manipulate. I don't pay attention to it. I'm certainly a little bit on that camp. I think that, I like the CAC payback period, because it's and again, I think it's part of the nature of being a very fast growing business, one that tries to, correct and make a lot of decisions super quickly. And I just feel that banking of something that it's going to happen maybe on, year 2 of the subscription, I think it's too slow for me to make decisions. Is that your dog, Ben? What breed is
small dogs? Yeah, I have 2 small dogs and I love the dog. So,
I mean, it's probably your dogs don't like LTV as a metric either.
I think they're like, Ben, stop talking about LTV to CAC. We hate it.
No, I think and other than that, to me, I repeat the same metric in context. The other thing that comes to mind here is having all of these many metrics, and we're on purpose doing a lot of metrics because that's kind of the whole purpose of the webinar, and we need to please different people that like different metrics. But for day-to-day thinking about the business and how to move forward, I do pick a few metrics carefully, make sure they are cohesive with each other, make sure you have all of the growth, efficiency, everything is covered. And then I'm not a big fan of looking at all the so for your business, you might choose whether CAC payback or LTV to CAC makes more sense. Yeah, I think if you have a lot of later year expansions, maybe you need to look at LTV to have the full picture. If not, I think I like CAC payback quite a bit. And then maybe every now and then, once a year, you might take a look at the other metrics, but just choose your metric that you wanna operate the business on, and then almost stop caring about that other long tail. Yeah. So I think Ben, you're replying the chat, which again, different businesses should pick different metrics.
Yeah, and understand the trade-offs, because you will make some conscious trade-offs between CAC efficiency and growth, as an example. Hey, Lucas, let's throw that second and final poll out, since we all seem to like the CAC payback period. I think we have a CAC payback efficiency question about how is the audience's CAC efficiency trending in the first half of 26. So is it getting better? Is it staying about the same? Or is it not improving, getting worse? Okay, I'm going to keep going, guys, in the interest of time. Now, here's one. Now, I was pleasantly surprised over the last 2 years that gross revenue retention, which is just of that existing customer base in a previous period a year ago, how did the ARR not factoring in expansion, just factoring in churn and downsells, how did it trend? It held up reasonably well in the last 2 years, but this year it's down 4%. It's the first time I've seen it this low, and this is subscription only gross revenue retention. So this told me, and by the way, we also segmented this, and it was seat-based subscriptions had the greater reduction, and usage-based pricing models actually didn't have quite as bad. But I was actually very concerned when I saw this, and I've asked it the same way a couple times, Ben and Albert, but did it surprise you that we saw that big of a change in the last 12 months?
Yeah, that is really interesting. And Ray, that's why I love your data, because we've always talked about 95% being elite. If you have a higher price point product, versus B2C or lower price point, and the data shows 95% top quartile. But now, yeah, I mean, this all kind of goes together with growth rates. It's harder to grow, and the attack on seat-based pricing. Because now customers may be doing well, but they can do well without adding headcount, and that directly impacts those selling seats. So that could be the death of seat-based pricing could be a little bit overblown, but it's directly impacting some software companies. So I think we're starting to finally see this in the numbers.
Yeah, and then Albert, what I wanted to ask you was, I'm a believer in continuous planning. So knowing if I'm tracking GRR really well, if I looked at my first half 26 numbers and I see that I'm at 84% and I had budgeted 88%, are most companies factoring and reforecasting their plan for the second half of the year based upon this type of metric trend?
Yeah, I think more and more, yes. And like that's one of the things that we talk a lot about with our customers, continuous planning. I think, a few years ago, you had the excuse to, correcting your forecast or doing a reforecasting process. It's very lengthy, very time consuming. There's, no one is happy about it and everyone suffers it. I think more and more today with tools like, Aleph, but also AI, I think it's much faster to do so. So I would say there's no excuse. And I think now you do need to take that into account, and even a very quick high level reforecast can give you a good idea of where you stand and if you need to make, further decisions or look into things more deeply. So I think no excuse to not do it this time around.
Okay, now a lot of people, they think, GRR is important, but what I really care about is my net revenue retention. And the cut I took at this initially for the audience here is to show you how net revenue retention performance impacts growth rate. No surprises here, but the companies that are growing the slowest, less than 10% in this particular population, was at 92% at median. And the fastest growing were at 111%. So to me, if I just looked at this without doing a whole lot of analysis, Ben, this is pretty easy to say there's got to be some pretty high correlation to your growth rate and your net revenue retention performance.
Oh yeah, definitely. I mean, to really be firing on all cylinders with growth, yeah, you need the expansion motion and new. You can't just rely on new forever. There's got to be a balance. And the two, I would say the two together, if you have really good new and expansion, that gives you that exponential growth rate. So yeah, no surprise with this chart.
Yeah. And to me, I think like some of that combination, Ray, of one, lower gross retentions across the board, even like, all the benchmarks shifting down together with this, that is like pretty healthy. I do think to me, it's a bit of a reflection of the market. I think a very popular, I'm sure you've heard these things around the K-shaped market and like, things going to different directions of with AI, some businesses are struggling and some businesses are, it's hard to justify still using it. But then the ones that are thriving are like really thriving. And it's also a massive tailwind for a lot of companies. So not surprised.
Yeah, the chasm between the top decile, top quartile, and the average, much different. But look at I love this one. This one, I always thought this would be more of a stark contrast. And this year it really jumped out in the data. And that is usage-based pricing companies where that's their primary revenue driver. 108% was the median net revenue retention. 75th percentile was 155%. Feels like snowflake from 2022, right? But look at the subscription by seats. And we did it for the first time where we said, hey, subscription's not well defined. So I wanted to differentiate subscription based upon seats and subscription based upon non-seats, committed transaction volume, et cetera. 98% was the median NRR. So under that 100% minimum threshold. So this tells me just at a service level that usage-based pricing is a superior model, but I know there's a lot of nuances there. Ben, you want to respond to that?
Yeah, there are a lot of nuances, and I'd say from this, it's interesting. Yeah, definitely, but I wouldn't, I'd say, hey, we've got to just do usage-based. And in my research of public tech companies and their pricing models, it's rare to find a large tech company with just usage-based, the only pricing plan. At some point, they have platform plus usage. They have the hybrid pricing. So yeah, its usage is also easy to scale down fast too. So I think it's interesting, but it just seems like that to get large, it's going to be a combination of pricing models.
Yeah, no, I agree. Now, see, we get 241. This may take a few minutes, but I think it's worth it because I know you just did a webinar on it. Albert, here's my question. As more and more companies move to usage-based pricing, having real-time visibility into how the usage, the revenue is trending has to majorly impact the complexity of forecasting. So I wanted to get your insight on forecasting and usage-based pricing models.
Yeah, for sure. I mean, definitely harder. But I think that's where my CEO hat and my CFO hat, collide. As a CFO, I like this visibility. As a CEO, I like more revenue. So I think like I would take more revenue with less visibility over less revenue with more visibility. And I think but I think jokes aside, I think like that's where some businesses will be seeing, right? Like if you're really adding value and if you're willing to put some of that at risk, I think there's a lot of value there. And then again, seats feel so good and so predictable, but in the end, you do see behaviors in usage-based, and there's a lot of businesses that have been usage-based for a while, and you start to, it's like the techniques are different, but you go into cohort analysis, you go into seeing behaviors. I would argue that if you have a decent amount of scale, at some point, there's a lot that you can even forecast about, based on analytics, product usage. And the data is so much richer than, how do I know if someone is going to add 3 seats tomorrow? I don't know. I need to be tracking their LinkedIn and see if their company is hiring. So I would argue that harder to set up. Once you set it up, it's actually probably not as bad to forecast.
Ben, I think before you joined us today, you actually talked a little bit about forecasting and usage-based models. Any top level kind of best practices you want to share?
Yeah, we were talking about usage and just upcoming budget season, and now all these software tools that have switched from subscription to hybrid platform plus usage. Boy, budget season is going to be different. Which tools changed so we don't go over budget next year on AI spend, internal use software. So I think it's really identifying the tools and the usage and who and caps, and there's a lot of frameworks. It's going to be a little bit harder, and I think we've got to do a little pre-budget season prep on the internal use software side and AI spend, just so we're ready.
Yeah, I did want to give one flip side perspective on this. We recently benchmarked about 500 CIOs and CFOs at Fortune 1000 companies about what pricing models they preferred from their both SaaS and now AI native software. 71% said they would rather pay higher price for a guaranteed fixed cost. They hate usage-based pricing from a budget and predictability perspective. So it's just something to factor in.
Yeah.
Okay, next one, Rule of 40. Now, Rule 40, we all know what it is. It's your revenue growth rate plus your operating income. Often you use free cash flow margin or EBITDA. It increased this year, 25%. If you look at the most recent public recurring revenue software companies, enterprise value to sales multiples, the rule of 40 has the highest correlation to the multiples. It's about 0.42 on a 0 to 1 scale. So it told me that since growth is down, that means expenses are down, operating profitability are up, right? Just simple math. And at medians, you can't do it like this. But hey, if my growth is 20%, that says that I'm about 5% free cash flow margin for this cohort. I don't know if there's anything you want to say about the importance of Rule 40 for private SaaS companies, Ben?
Yeah, I definitely look at it, the right metric at the right time. And Rule of 40, I think, is a good discipline tool as well during budget season, just because there are always trade-offs with capital allocation. So it's something that I look at. I don't over-rotate on unless we're going to market, trying to sell, trying to fundraise. But yeah, and you see, it seems like, right, it's shifted now. Like, we've gotten tighter, but also the market's rewarding growth a little bit more now, according to, right? And so they're lovers and haters of the Rule of 40. I don't know if it'll go away. But like you said, it's highly correlated, or it is correlated to better enterprise value if you've got a nice Rule of 40, and if it's weighted towards growth.
Yeah. Albert, how about you? Is this something you look at for your company, and how much does it get discussed with your customer base?
Yeah, definitely with customers. I think especially, so I do think in the, like everything is relative to where you are as a company. I do think that the one place where I don't love Rule of 40 is if you're in like hyper growth mode and you're in like the multiple hundreds, then it's like too much, too positive to too negative, right? Like in the end. So I do think that like if you have, more in the, like double digits growth, I think that's where it starts to become more interesting. So definitely seeing it a lot for some of our more like, less for the VC-backed hyper-growth customers that we work with, and much more for maybe like growth stage PE-backed, for which this is much more relevant.
Definitely. Growth stage, PE-backed, they're going to be very interested in this. Now, here's what our last metric, I believe, we're going to cover, and last benchmark. And I did this with a purpose, and that is gross margin. Now, I almost never talk about gross margin in a benchmarking webinar because it's remarkably stable, right? 79, 79, 81. I was a little surprised with that last year, 80%. But Ben, I don't know if you saw, but Databricks just came out with their latest earnings report, and their gross margin went down 6 percentage points quarter over quarter. And they said it was almost entirely because of their increased inference cost. So I wanted to see if you wouldn't mind taking a little bit of time and talking about a couple new metrics that operators need to think about, and we're going to start benchmarking in the future.
Yeah, definitely. I mean, it's funny, right? Because when I work with my clients, we are always looking at gross profit, margins by revenue stream. Do we have inference costs now that we've got to keep separate? So this is where things are changing right now, and we've got to implement these, I'd say, these changes now in our chart of accounts so we can forecast these correctly, so we can have a good budget season. But now we've got AI COGS, and just like the Databricks example, we've got, of course, inference costs. We need a new GL count for that in COGS. Plus, you could have infrastructure surrounding the inference costs, right? It's not just token cost feeding our product delivery. And then also like training, fine tuning. Is that for deployed engineers, and that's sitting potentially in COGS? Is this the dev team training our product that could potentially be CapEx? So we've got to be careful there. And then what about our support function? Do we need different support team to handle the AI product line? Can our existing support team handle that? So now we've got to implement a little bit more detail in our COGS area and our GL accounts, so we can separate regular legacy margins from our AI product margins, because definitely the boards are going to ask. And we've seen this trend, that in 2024 is kind of like, hey, we're launching AI. 2025 was, hey, here's our AI revenue. 2026 is now, here are our AI margins. So the sophistication is ramping up. You see this in the public markets with public companies, that they're getting more sophisticated. It's not just, hey, I've got AI, but now you've got to prove that it's accretive to your company.
And Ben, I just did some AI cost management research, and two things jumped out for those AI product companies that are leveraging third-party LLMs. That the two biggest costs that weren't expected and were under budgeted and forecasted were the associated AI infrastructure, the vector databases, et cetera. Also, even network capacity, because they realized that they sometimes had to buy larger dedicated capacity because it was so much more data intensive. So, and the other thing, companies were missing their AI infrastructure cost forecast by a median of about 21%. And this was Fortune 5,000 companies. So this is so critical and it's evolving. And I wanted to flip it over to Albert and say, Albert, do you find that when companies are leveraging your solution to do planning, et cetera, that they have to now go down to this next level of kind of insights they haven't done before?
Yeah, for sure. One very popular connector that we have now is connecting to things like Claude, the Claude Cost API, and be able to get a lot of detail from there. It's definitely early, so I think when I think a lot of this, and I think Ben was alluding to this, with even creating the chart of accounts to do this properly in the ledger, and I feel like there's the proper way, which is you want like more of your FinOps. You want to make sure that everything goes into the ledger in the right way. I think people are like still in the catching up moment, and there's a lot of like hey, maybe my QuickBooks NetSuite doesn't show this in the proper way, and I'm doing like some over-the-top analysis on top, and just trying to have my management view of this. So definitely a thing, definitely moving very fast, and it feels like everyone is in some way catching up to what's the right way to accounting for it.
All right. Okay, Ben, we're going to go to the next page. And I mentioned before that we co-founded the SaaS Metric Standards Board. So I love it when we can introduce new metrics to the audience. So with that, why don't you talk about the two new AI metrics that you're having your customers use?
Yeah, definitely. And I'm going through this right now with my client base. We're improving the chart of accounts. We're getting all those AI costs segregated into different GL accounts. And these, like Albert said, we're catching up now. There's a lot of theory of what we want to do, but also some things we can do today if we put the chart of accounts in place. And one, AI COGS ratio, pretty straightforward. So how much is AI costing us as part, percentage of total revenue if we put that chart of accounts in place? And then two, the inference expense ratio, or efficiency ratio. And this is AI revenue divided by inference cost. And this is like my ROSE metric, how much recurring revenue you generate for every dollar employee investment in employee and contractor now agentic spend. We want that revenue density. So this is like a revenue density metric for the tokens and infrastructure going into your AI product delivery. How much revenue are we delivering? And these are kind of general frameworks that I'm just kind of putting together from different reports that I see out there from investment firms, et cetera. But this is a good one. We want this moving up and to the right with the efficiency ratio, and that'll be a direct tell if your LLM-based product line is generating enough revenue to produce margins. And that's the big debate now, is just where our AI margin's going to go.
Honestly, I really love the inference efficiency ratio. And one of the reasons I love this is, it's really important for an AI product company or a SaaS company with an AI product, because you want to know kind of what that return is. But this is also great for operational and agentic AI for larger companies who are investing $1 million in their AI infrastructure. But what return are they getting? How many expenses are they reducing? How many headcount have they saved? How much additional revenue? So metric number 2 is good for both product companies and any company investing in AI, Ben.
Yep.
So one of the things, Albert, as the presenting sponsor for this year's benchmarks, I just kind of wanted to give you an opportunity to do two things. Number one, how is AI impacting your category and your customer base? I know it's a big question, but what are the 2 or 3 areas that you see AI really playing a critical role?
Yeah, I think AI is changing dramatically the way that finance people work, and I think the speed at which people are able to move. I think finance has been forever been caught in this cycle of I want to make my processes better, but I don't have the time to actually make my processes better, and I'm always like chasing the next month-end cycle, the next quarterly reporting, and I think like rightfully so. Things used to take a lot of time, and then revamping the way that you do OpEx planning would be a 1 month project. I think AI changes that, and AI makes it so that, going back to what I said before, there's no longer an excuse to not do things differently and not make processes better. And I know we've been able to revamp OpEx planning processes in like one afternoon, and connect up the reporting packages in like a matter of a couple hours. So I think definitely changing things, and no longer an excuse to do things the same way in 2026.
Cool. Okay, so with that, Lucas, Ben, and Albert, do we have any other questions from the audience that we should engage with or chat content?
We do. So we have a few. I'm happy to read some of those and maybe direct them to you, Ray or Ben, whoever wants to take it. But we had a question. We had a couple of questions around retention. So Neil was asking, do you see the GRR reduction correlated with shifts from seat-based to consumption? I don't know if anyone wants to take that one.
Yeah, so I'll take it. I do know for a fact that the GRR was lower for seat-based subscriptions versus usage-based. I'm not going to quote the number because I don't have it off the top of my head, but it's on the interactive filters. But what we did not track was as people were migrating from seat-based to some hybrid model with usage, how that impacted. So we don't know what the transition period impact is, Albert.
Yeah, I wonder, Ben, you work with a lot of companies. So beyond the data, you probably have some like anecdotes, right? So what's your take there?
Yeah, I think it's going to be part of that, but I think actually, thinking about this, I think 2026 is when you're seeing a lot of pressure on renewals. So Ray, I mean, this will be interesting when you run your data, survey again. That I think there'll be increased pressure on that, because that's what you're hearing from CFOs. Like, hey, my AI, like Claude can do this, what your tool is doing. So, I'm having a lot of conversations with my founders on, all right, what are competitors doing? What's AI? What are the AI expectations? What's your customer base saying as far as like expectations around product roadmap? So I definitely think, and you're hearing these, where they're hooking an agent, having it log into their CRM system and doing everything in your CRM system, and then they're cutting seats. So yeah, hearing a lot of things right now around this.
Okay, other questions?
There's one question that I think we touched on before this, but like we can expand a bit. Matt is asking, I know we're only halfway through 2026, but is there an indication on how the growth rate is changing this year versus 2026?
Ben, I'm going to have you address this anecdotally, then I'll tell you what 2 of my surveys have said.
At least from working with founders, I think it's still patience mode, right? So I think growth rates are not improving just yet. Again, there are a lot of examples of where companies doing well. Others, I think it depends really now on the vertical you're attacking, where in some industries it is very hard. You've got to be patient. We've just got to get through this period, where others, are implementing pricing changes that are increasing revenue. So it just depends. But I see a lot of just like building the business, being patient, and hopefully the macro conditions will improve.
Yeah, we've done 2 surveys, not specifically about growth, but we included growth, and we saw no more than a 2% change, higher or lower in those 2. So pretty stable, echoing your points. By the way, I wanted to mention one other thing because I pulled up the data on the interactive portal. Subscription using seats-based gross revenue retention, median was 81%, 25th percentile was 74%. but subscription using a minimum commitment to usage, it was at 90%. So 81% GRR versus 90%. That tells you a lot.
Yeah.
I know we're 1 minute out. Ray, I don't know if you have any parting thoughts for us.
No, I think the main thing, and let me see if I can get back to this. I think for the people who hung with us for all this time, the most valuable thing you can have is to go to this link at the bottom, take a picture of it. We also have it on benchmarkit.ai, and then go and look at either the current year benchmarks or the longitudinal over the last 4 years. I know that Ben and you can reach us. I'm at Ray Rike on LinkedIn. Ben, how can people reach you?
I'll put you can always email me at ben@thesaascfo.com.
And Albert, for people who want to learn more about either the benchmarks, the benchmark report, and of course your platform, what's the best way to reach out to you?
Yeah, I put my LinkedIn there on the chat. Feel free to connect with me on LinkedIn. And then I'm albert@getaleph.com if you want to reach out via email.
Okay. Thank you, everyone, for attending, but a special thanks to Aleph, who was the presenting sponsor, and to Ben and Albert for being here with me. Goodbye, everyone.
Bye. Thanks, guys.